So what is a put credit spread and how can you trade it on Questrade? And to fully understand what a put credit spread is, I think it's important first to know what a put option is. So according to Investopedia, a put option is a contract giving the owner the right. So in this case, the owner is the buyer of the put option. So giving the owner the right, but not the obligation to sell a specified amount of an underlying security. So it gives the buyer of the option the right to sell a stock at a predetermined price within a specified time frame. So if someone buys a put option, it gives them the right, but not the obligation, but the right to sell their stock at a predetermined price, at a chosen price within a specified time frame. So that's a put option. So who will normally buy put options? So usually people who own stock and are afraid that their stock could go down, they want to protect themselves, they'll buy a put option at a specified strike price or predetermined price to guarantee themselves that they will get at least this amount of money in case the stock market crashes or the stock crashes. So if someone bought shares of a stock at $200 and they're afraid that in the next 30 days that stock could drop hard for whatever reason. So they can buy insurance, they can buy a put option to protect themselves, let's say within the next 30 days. So let's say they want to protect themselves at $200. They don't want to lose more than $200. They don't want their stock, they don't want to sell their stock lower than $200. Then they can buy a put option, let's say for $4. If they wanted to protect themselves, if they want to make sure that they don't lose more than $195, that the lowest they can sell it at is $195, then the put option will cost less, of course, then they'll just pay $2. If the lowest they're willing to sell it at in the next 30 days is $190, then their put option is going to cost them $1. So that's what a buyer of a put option normally would do. Now this is the value of the put option if the current price is $200 and there's 30 days to go until the expiration of this contract. But if the stock drops, then this insurance will go up, of course. The value of these put options will go up. So some people will actually just buy put options without even owning the stock. Some people will buy put options just to trade it. So if they think that a particular stock might go down, they'll buy a put option, and then when the stock goes down, the value of that put option goes up, and then they'll just sell it for a profit. So for example, current market price, let's say is 200. If they buy a put option at $200 strike, they pay $4. And then if the stock drops to $195, then their put option that they bought at $4 increases to $6. So they can sell it and make a 50% profit or whatever, 2 over 4, yes, 50% profit. So that's what buying an option means. So if you're selling an option, you're on the other end of this contract. If the buyer of the option has the right to sell something, to sell the stock at a particular price within a given time, if you're selling that person the put option, that means you might be forced to buy these shares from that person at a particular price in a given time frame. So if you're the seller of the put option, you have the obligation to buy the shares from that person if that person decides to exercise their right to sell the shares. But even if the person doesn't exercise their right to sell the shares, you could automatically get exercised or assigned the shares if the put option is in the money come expiration. So what does in the money mean? So if at expiration of the contract, the current price is $195. This strike over here, the $200 strike, is in the money. Why? Because the current market price is trading below the strike. That's considered in the money. So you will get assigned. If you don't take any action, you will get assigned the shares automatically. This $195 strike is considered at the money. Nothing will happen. The option will expire worthless. This one here is considered out of the money because it's trading, because the current market price is above the strike of 190. So these two strikes are considered safe at expiration if the current price is 195. The $200, because it's above the current market price, then it's considered in the money and is in danger of getting exercised. And the value of that put option at expiration, this one will be approximately $5 because at expiration, there's very little time value left in the option. So whatever's left is real value. And the real value of this put option is the difference between the strike and the current market price. So it's going to be about $5, a little bit more. This one's going to be close to $0 because it's at the money. And this one is definitely going to be close to $0 as well. So the buyer of the put option at this strike, if they pay $2 to protect themselves in case the stock drops, and the stock only went to 195, whatever they paid here just got lost. It's wasted insurance. But if the buyer of the put option bought this put option here at a 200 strike, they bought it at $4, right now it's trading at $5, then they just made a profit of $1. If the person that owns the stock or owns the shares and bought the shares at 200 and bought this put option for protection, so that they don't sell their shares lower than $200, they have two choices. They can either exercise their put option to sell the shares at 200, so they would get back $200, but they paid $4 of insurance to guarantee themselves being able to sell the shares at 200 if it's trading at 195 right now. So instead of owning shares that's $5 less in value, they paid $4 in protection and they were able to sell their shares for 200. So in essence, they saved $1 per share. Their other option is to keep their shares that they bought at 200 and just sell the put option that they bought at $4, sell it for $5, so they make $1 profit from the put option, but they still own shares that's down, but they still own shares that's worth $195, so $5 less than what they bought it for. But it's an unrealized loss because they didn't sell it yet, but they made a profit of $1 with their put option. So a put credit spread is an option selling strategy, which means you open the trade by collecting a credit. You actually get money in your account when you open the trade, but it doesn't end there. You have to close the trade at some point. And to close the trade, you close it for a debit or you let the options expire worthless. So how do you make money from this? By either closing it for a smaller debit than the credit you received, or you can just let it expire worthless if the trade is going in your direction. So a put credit spread is the combination of selling a put option and buying a put option at a different strike, but within the same expiration. So for example, if a stock is trading at $500 and you think that within the next 30 days or at expiration, 30 days later, you think that the stock will be trading above $450. So the trade that you can make to make money from this assumption of yours is sell a put option at a $450 strike, collect $2, but then buy the $445 put option. Buy the put option at the $445 strike and pay, let's say, $1 and pay $1. So your net credit in this case is the difference, $2 minus $1. So you collect $1 from this trade. But what's your max loss? Well, first of all, your max loss is achieved if the stock is trading way below $445 come expiration. If it's trading at $445 or lower, you achieve max loss. What is this max loss? So if the stock is trading at $445 at expiration, this put option here is going to be worth $5 because it is $5 in the money. This put option here, it is at the money, so it's going to be worth $0. So when you open the trade, you collected $1, but then when you close the trade, you're going to pay $5. So you end up losing $4 on the trade. Remember, a contract is 100 shares, so you're actually losing $400 in this case. And you could buy more than one contract. You can buy 2, 3, 10 contracts. So just multiply that dollar amount by the number of contracts you have. So the advantage of a put credit spread is that it's defined risk. If the trade goes against you, you have a max loss. So as you can see, the max loss, if you figured it out, is the difference between both strikes. So in this case, $5 minus the credit that you received initially. That will always be your max loss, regardless of where the stock is trading. If the stock is trading at $400, so remember, your initial assumption is at expiration in 30 days, this stock is going to be trading above $450. So I'm going to go ahead and make this trade to make money. But then your assumption was completely wrong. The stock is trading at $400 come expiration. This option here at expiration is going to be worth $450 minus $400. So it's going to be worth $50. So you collected $2 initially, and now you have to buy it back for $50. So that's a big loss times 100. But because this is a spread, you also bought the put option 5 points lower. So this is like protection for yourself in case the trade goes against you, in case the stock is trading way below your strike price. This is your max loss, the difference between both strikes. This put option here is going to be worth $45. So once again, your max loss is the same. You collected $1 from opening the trade and you paid $5 to close the trade. So your max loss or your net loss is $4. So this is why you buy that put option for protection. Because if you didn't buy this put option and you only sold the put option at a $450 strike, yes, you collected $2, but then if the trade really goes against you, you might end up paying a lot, or you're gonna have to buy the shares. Because remember, the buyer when you sell that put option, someone else is buying it from you. The buyer of the put option has the right or obligation to sell you the shares at that strike price. And that's going to happen if the option is in the money. And the option is going to be in the money if the current market price is trading lower than the strike price. So if the stock's at 445 or if the stock is at 400, it's considered in the money because it's trading lower than the strike price. So as the seller of the put option, you have the choice to either buy back the put option to close the trade, or you can let yourself get assigned and end up owning 100 shares of that stock at $450. But you got a $2 discount. So it's as if you owned it for $448. But then you've got $448 times 100 shares of capital tied up. So they're both valid strategies. It really depends what you want out of the trade. Put credit spread will have a better return on capital, but some people will sell the puts alone if they actually want to buy the shares, but they just want to get a discount on the shares before buying it. So that's actually something Warren Buffett does, is if he wants to buy shares of Coca-Cola or Kraft Heinz, before buying the shares outright, he'll sell a naked put option. He'll sell the put option only at the strike that he's comfortable buying the stock at. If the stock ends up lower than that strike, then he'll end up owning the shares plus a little discount of the premium that he collected by selling the put option. If the stock ends up above that strike price, then he won't end up owning the shares, but he just collected premiums. He just made money by selling the put option and having it expire worthless. You didn't have to buy it back. It expired worthless because this market price was trading above the strike price. So what happens if the stock is trading at $600? So in the example of a put credit spread, what happens if the stock is trading at $600? What is our max profit? Both these options will be trading close to $0. So you can either let them expire worthless, and your max profit is the initial credit that you collected when you opened the trade. So your max profit in this trade, regardless what happens, is $1, and your max loss is $4. So your max loss is the difference between the strikes minus the credit that you collected initially to open the trade. Now in practice, you don't have to wait till expiration to get out of the trade. You can get out of the trade earlier. So if the initial trade was 30 days long, if the trade is going in the right direction, if it's trading at 500, if it's trading at 480, 475, 15 days later, you might be able to close this trade here that you collected $1. You could close it maybe for 50 cents, 60 cents, maybe even 30 cents. So you collected $1, but you paid 50 cents. You're left with 50-cent profit. That would be your profit of the trade in 15 days, for example. So that's the general idea behind the put credit spread. It is a bullish strategy because you use it when you think the market or when you think a particular stock is going to trade above a certain price. What's great about it is it gives you a lot of room to make money, because if the current market price is 500, you could still be wrong by about 50 points and you would still make $1 profit. And your risk on this trade is 4. Your max profit is $1. So that's a 25% return on your capital. So you can make money anywhere between 450 and above. And usually if the stock starts moving up, if the stock goes to 510, 520 within the first week, you can actually close the trade already for 50%. Now you can get closer. What happens if you choose a 475 strike instead of a 450 strike? You'll collect a higher credit up front, but then you have a smaller chance of being right because you're closer to the current market price. You have less room for error. So it's a trade-off. You have to decide how close you want to be to the current market price. How much margin of error do you want? But it's a trade-off. You'll be collecting less premium if you want more safety. You'll be collecting more premium if you get closer to the current market price. All right, so how to trade a put credit spread using Questrade. All right, so first of all, to trade put credit spreads with Questrade, you need to have a margin account. You cannot trade put spreads in registered accounts. So TFSA, RSP, RESP, you cannot do put credit spreads, only in a margin account. Not only can you do it in a margin account, you need to have level 3 option. And to get level 3 options, simply go to accounts, not in your trading interface, but in your accounts interface. You go to account management, you choose your account if you already have a margin account. Then you have option level over here. You could see here, you could change it and choose level 3. You might have to fill out a form and just send it to them. You could upload electronically, very easy. And as you could see here, level 3, minimum balance required to place a trade is 5,000 Canadian. So with level 3, with Questrade, you could do all these strategies here. Registered accounts have a maximum level 2 option where you cannot do all these strategies, but you could do covered calls in registered accounts. But even if you have a margin account, doesn't automatically mean you could do these strategies. You need to get level 3, which is very simple. You just have to choose it, fill out a form, send it back to them. So that's the first step to trading put put credit spreads in with Questrade in a margin account. If you don't have a margin account, very simple, you can open a margin account. Don't forget to use my referral code below. I've got 2 referral codes. One gives you up to $250 back depending on how much you deposit, and the other one gives you $50 in free trades. All right, so on your trading interface, simply click on option, look up the underlying stock that you want. Let's say you do a put spread on the SPY, click this, look it up. And then over here, right over here, you've got all the different strategies. So a put credit spread is a multi-leg options because there's 2 legs to the options. There's a put option that you sell and there's a put option that you buy. So it's under vertical. It's a vertical spread because it has the same expiration. So you're going to click on vertical. You're going to choose the expiration that you want. So let's say we want the February 21st expiration. And then on this side, it's a call credit spread. On this side, it's a put credit spread. Simply click anywhere. It doesn't matter. Make sure you're on the put, click buy, sell. And then over here is where you choose everything. So this is the order entry window. So you're going to change it up. So remember, a put credit spread is where you sell a put option at a particular strike, but then you buy a put option at a lower strike. But you can also do the opposite. If you're bearish, if you have a bearish assumption, so if you think the stock will go down, you could do the opposite. You could buy a put option at a particular strike and then sell a put option at a lower strike. So, but this way you're actually going to pay. You're not going to collect the credit, you're going to pay. And it's the same thing. Your max profit will be the difference of the strikes minus what you paid. So this trade exactly can be done in the opposite direction. You can pay $1 to open this trade and your max profit is $4. But to achieve max profit, you would want the stock to drop below 445. So if you have a different assumption on the stock, you could actually place this trade in the opposite way by buying the 450 strike and then selling the 445 strike. This would be called a put debit spread, but you're paying money up front first, hoping that the stock drops below 445 so that you can make that $4 max profit. And once again, if the stock starts to drop, you can get out of the trade earlier for maybe $2. So you bought it for $1, close it for $2, you make $1 profit. So it's the same idea. It really depends on the assumption. But in this video, I'm talking about a put credit spread. The reason I just mentioned this is because automatically when you click on vertical with Questrade, it sets you up as a put debit spread. So you simply have to change it by clicking sell. Notice when I clicked sell, it changed this one to buy. When I click buy, it changed this one to sell. So if I click sell, you could see that the higher strike is the one being sold, but you could change the strikes. So right now the SPY is at 328. So let's say I assume that on February 21st, SPY will be trading above 315, for example. So I could go sell the 315 put option, but then I have to buy a put option for protection, right? So I'm not forced to buy the shares if my put option is in the money. So I'll buy a put option for protection, let's say at 310. So right now the market is closed, so there is no bid and ask. But normally you would see a bid and ask right over here, and then you would just choose something in between. So since we're selling, we would be on the ask side, but of course we're not going to get exactly what's on the ask side. We're selling to someone, so someone's buying. So if you want this trade to get filled right away, you would enter a price over here that is closer to the bid side. But usually you can start off in the middle and then get closer to the bid side. For the purpose of this video, I'm going to assume that this was done at the same time. So as you can see, you would collect about 50 cents. You would sell for $1.50, you'd buy for $1. So the difference is about 50 cents. So you'd collect 50 cents on this trade. Your max loss is the difference between the strikes. So the difference between the strikes is 5 minus the premium that you collected is 50 cents. So your max loss is $4.50. But that only happens if the SPY is trading below 315 come February 21st. So you still have a good chance of being right and keeping that 50 cents. But remember, that's because I went pretty far to give myself enough protection at a 315 strike. But if I get closer, let's say I go to 320 strike, I can collect about 75 cents instead, and my max loss being $4.25. So now you have to decide, getting 5 points closer, is it worth that extra 25 cents? So once you choose your strikes, you pick the amount that you want to collect from this trade. It'll be something between the bid and the ask that usually shows up here, but the market is closed, so we can't see anything right now. But it'll be something closer to the bid. You enter it here. Make sure that you see CR here. Make sure that it says credit like this. It has to say credit. Then you can send the order. And as you can see, it says sell one SPY, February 21st, 2020, 315 vertical put at a credit of $1. Sell to open buy to open. So as you can see, it's to open. You're opening this trade, but you're actually selling to open and then buying to open. And to close the trade, you're going to end up selling to close, buying to close. So you're selling to open for $1, for $1 credit, which is one contract. So it's 100 shares. So it's $100 that I'd be collecting. My max loss in this case is $400. You can see here change in maintenance excess is $400 plus the commissions. Commissions, if you have active trader pricing with Questrade, it's going to be $5 to open the trade and then 75 cents a contract. So I've got two contracts here, one put here, one put here. So that's $1.50. So $1.50 plus $5, $6.46. And then I would just send order. And then if I want to close the trade, if it's profitable, you're going to see it under your positions, right? So let's look at a SPY put spread that I have here, or even Facebook or whatever. Yeah, so I've got a Facebook put spread here expiring February 14. I've got a 205 put that I sold and a 200 put that I bought. I collected 80 cents, as you can see here, the difference between this and this, 230 and 150, 80 cents. But as you could see right now, if I want to close it, I'm going to pay more than 80 cents. I'm going to pay probably $1, because you could see here there's a difference here. There's a loss here because the market dropped on Friday to 217. But when Facebook was trading at 222, I was actually able to close this for a small profit. I still have until February 14, so I still have time, and I'm still what, 12, 13 points away from my short strike being in trouble. But there is a risk here because I've got earnings coming up, and usually there's a lot of movement after earnings, but we'll see. But that's, if you want to close the trade, basically, you have to make sure that under group, you're under strategy, so that you can see the create order function. And then you simply click on create order. It automatically updates the order entry window. You simply put the price that you want to pay. So let's say I want to pay 50 cents to close this trade, or I collected 80 cents. So I usually try to close it for 50% profit. So I put in 40 cents. So see, as you can see here, it's a debit. So when I opened the trade initially, it was a credit. Now I'm closing the trade, it's a debit because I already own it. I'm already in the trade. I click send order. You can see that now it's buy to close, sell to close. Before it was sell to open, buy to open. Now I'm closing the trade. I no longer have the risk of the options. Closing it for $40, well, let's say I collected $80 to open the trade. So my profit is the difference. And obviously you have to take into consideration the commissions. But if you have two contracts, you're going to be paying less commissions. The problem with the commissions with Questrade is that initial $5, 75 cents a contract is very fair. Most brokers will have that. But that initial $5 to open the trade becomes a killer if you're not trading enough contracts. But whatever the trade can still be profitable. And basically just send the order and then wait till it gets executed. That's it. That's how you would sell a put credit spread with Questrade. That's simple. Obviously, there's different approaches to selling put credit spread. I think that deserves its own video. For example, which strikes do I choose? How far do I go? How close do I go? When do I close the trade? What do I do if the trade gets in trouble? What do I do if the stock drops below my put option? What do I do? But I think that deserves its own video. In this video, I just wanted to explain what a put credit spread is and how to actually execute the trade in Questrade. So if you have any questions, leave them in the comment section below. And like always, if you're going to open an account with Questrade to trade on the stock market, use my referral code in the description below the video to get up to $250 back. Thanks for watching.